Hi, John from York Bay Financial Partners, looking at investment markets. Really a pretty tumultuous week in the US. Really all started with President Trump and Vice President J.D. Vance berating and humiliating President Zelensky from Ukraine. Blaming him for the war, blaming his country, and all the time just really sort of indirectly praising Putin and giving no sort of criticism to Putin at all. And after all, it was Russia that actually invaded Ukraine, not the other way around. Now, Trump has followed up his criticism now with suspending any military aid to Ukraine. All the time blaming Zelensky for not wanting a peace deal and a ceasefire. Whereas on a daily basis, Russia continues to bomb and send drones over to Ukraine to blow buildings up. And then Trump has now also put into place the tariffs on Canada and Mexico and increased the tariffs on China from 10% to 20%. Now, just about anyone with any credibility is saying that tariffs are inflationary. It's not the country of origin that pays the tariff. As soon as the goods come into the US, the importers who go and collect them from the port end up paying the tariff, which then get passed on to the end consumer. So it is inflationary and a tax on the US consumer. And for the first time, Trump has sort of admitted that there could be some short-term pain for the US economy. So you've got rising prices, you've got rising unemployment. And Trump's approval rate as well, taking office, is one of the lowest since records began in around the 50s. The only person to have a worse approval rating when taking office was actually Trump himself in 2016. So against that backdrop, you've seen equities sort of sell off, because potentially you've got a slowing economy, but also as well you've got rising inflation. And Trump's approval rating could take a further hit as the sort of fall in equities will start to filter through into the US sort of 401 pension plans. And certainly with many of the goods coming into the US, they actually impact on sort of manufacturing and production within the US in terms of sort of car parts, etc., for manufacturing plants that have to go buy imported goods to actually finish the product. Now, yields in the US have dropped dramatically as potentially a slowing economy. The 10-year is back at 4.19, and the 2-year is below 4% now at 3.96. So while Trump may sort of point to a slowing economy needing lower rates, it's going to be hard for the Fed to sort of cut interest rates with inflation increasing. And then Trump will give his State of the Union speech to Congress later this week, and that will be very interesting to see what sort of is revealed during that speech. Because at present, it's fair to say it hasn't been a smooth transition. And also as well, there's quite a bit of disapproval with Elon Musk and his Doge department going around slashing things left, right and center. and really coming up with some sort of interesting numbers as well. So potentially with the US economy slowing, oil's backed off and is well below $70 now at 68.10 and change. And again, the sort of strange irony there is that, with those lower prices, if Trump is really determined to sort of drill, baby, drill, that would force the price down even further, which will then impact profits for these oil companies in the US. Now in the UK, sort of Keir Starmer, the PM, has actually come out of this whole sort of Trump thing reasonably well, because he's hastily organised a meeting with Zelensky in the UK, and then getting the rest of the European leaders on board and sort of having meetings to try and sort of come up with a European peace plan. Which certainly has gone down pretty well and maybe helps deflect with some of the issues within the UK economy. With the EU, Ukraine is obviously sort of front and centre, and just celebrated its 3rd anniversary of the war there, and that was sort of quite interesting because despite Russia talking about looking for a sort of peace deal and ceasefire, on that anniversary they launched over 200 drones. But in terms of economic news in the EU region, inflation is sort of falling again a little bit, and potentially that could see the ECB cut interest rates further this month. The inflation came in at 2.4 versus 2.5 last time around. Now in Australia, after the hawkish cut from the Reserve Bank, really waiting to see what sort of impact the US sort of tariffs do have on the Australian economy. Although on a positive note, the Chinese economy is actually starting to sort of improve after all the workers return after the holiday period. Now here in New Zealand, it has been a very good summer for tourists. Numbers are up, and also spending is up as well. So that's helping to offset some of the sort of weaker domestic economy in terms of, sort of New Zealanders spending money, and really still waiting to see the full impact of these rate cuts. Although potentially that should start to sort of filter through to the economy over the next sort of 3 to 6 months, because many mortgages will be reset. And some of those mortgages could be reset at sort of 1 to 1.5% lower on their interest rate, which will obviously have a pretty major impact on disposable income. But still fully expect the Reserve Bank to cut interest rates again further at the April meeting. So if you are looking for income options, go to the website www.bayfinancialpartners.co.nz for lots of interesting articles. I look forward to speaking to you soon.